calculation of cost of equity, and weighted cost of capital to reflect changes in capital structure. The cost of equity represents the return required by shareholders for investing in a company, reflecting the risk associated with equity financing. When a firm introduces debt into its capital structure, financial risk increases because interest payments must be made before dividends can be distributed. As a result, shareholders demand a higher return to compensate for this increased risk. Modigliani and Miller developed a formula to estimate the cost of equity for a geared company by adjusting the cost of equity of an equivalent ungeared company. This formula incorporates the difference between the cost of equity and cost of debt, the relative market values of debt and equity, and the corporate tax rate. The weighted average cost of capital, WACC, represents the average return required by all providers of finance, weighted according to their proportion in the company's capital structure. It is calculated by combining the cost of equity and the after-tax cost of debt based on their market values. WACC is a key discount rate used in investment appraisal and valuation because it reflects the overall cost of financing the firm's assets. When capital structure changes, both the cost of equity and the relative weights of debt and equity change, which in turn affects the WACC. Financial managers must therefore recalculate WACC when evaluating new financing decisions or strategic investments. Adjusting WACC for changes in capital structure is particularly important when using proxy companies or risk-adjusted discount rates. If a comparable firm has a different gearing level, its cost of equity must be adjusted to reflect the target company's capital structure. Using equations, analysts can ungear and then regear the cost of equity to match the desired debt-equity mix. This approach ensures that the discount rate used in valuation or investment appraisal reflects both the business risk and financial risk of the company being analyzed. Accurate estimation of WACC helps managers make better investment decisions and evaluate the financial implications of alternative financing strategies.